Good evening, everyone. Please, can you hear me, please?
Good evening, sir. We can all hear you, sir.
Good evening, sir.
Good evening. Good evening.
Good evening, sir.
Good evening, ma.
Good evening.
Good evening.
Good evening, sir. Good evening, sir.
Good evening, everyone. Good evening, everyone. How was the rain today? How was work today? How was the rain? The rain was today. You get us bill.
Seriously, wow.
It's not rain for our side there.
Ha.
We don't have rain. Oh.
You don't have rain? Are you in this Nigeria?
Yes, sir. We are in Sokoto. It's not rain. It's not rain.
We'll be back here. We
are enjoying you.
That rain has been falling since yesterday.
You are enjoying you.
We're enjoying rain like this. Oh, wow. You know the funniest thing about life? They are saying we were enjoying, but today at least we wanted a little bit of sun.
Sir, the heat is too much. Even here, I'm feeling the heat seriously.
Me like this, I'm wearing 2-3 clothes together. I'm feeling cold.
It has been falling in for over 3 weeks now.
Life is no balance. But you know, this life is not balanced at all. But you know the thing that is very balanced.
Sir, like I'm
saying, please help me with your microphone, please. What was I trying to say something? What was calling me? Okay. So I was saying, please help me with your microphone, please. I was saying that this life is not balanced. But you know the only thing that is balanced is that plus person that is feeling it, plus person that is feeling cold. If SFM touch all of us this night, we'll feel the other way.
That one.
If SFM don't enter body like this, when they feel cold, it go catch them. The same way they hot, cold go grab them fast. Because what you want to do tonight, at least, is a little bit here and there. So just be prepared, just be ready. Anyways, thank you guys very much. So once again, good evening, everyone. You're welcome to class. You're very welcome to class. So we started with our cost of capital, and we've done quite a lot. We've done quite a lot in my own group. So please now, what's up with the microphone? Please help me with your microphone, please. Thank you very much. We've done quite a lot. In my own books. We've done quite a lot with our cost of capital. I don't know if I should do this or I shouldn't, but I would. Even if you guys say I should not, I would. Now, what I want to do is tell you guys some things that I feel like, some aspects I feel like you guys are not making a lot of effort. You guys are not making a lot of effort. Number one, I noticed that some of you in some of the groups, you are just there silent. I know the groups are locked, and it's for a lot of reasons. Anyways, I know the groups are locked, but you can encourage your lecturers in a whole lot of ways. If we were paying us now, it's a different ball game. You could have said, "Oh, okay, I could pay it for you to do this service for me." We could encourage your lecturers in different kind of ways, like just show that, this is what I'm saying. With online classes, it's different because you don't know if the person you are talking to is listening to you. You don't even know if the person is getting any message you are passing. But if it's physical, I see you, you see me. I know if you are hearing me, you are not hearing me. So the only way to show that you're actually getting these things from that group chat is to please react. It's not really easy on our lecturer's part. On us, believe me, it's not easy. I'm not even going to lie to you. It is not easy at all. After all today's stress, rain, everything like this under outside like this, I'm covering myself with mosquito, with cold, everything at the chest time. So what I'm saying is the only way you can at least compensate us a little is let us know that you are also making effort from your hand. Make efforts by reading, and please, when we send materials, show that you've seen them. I know you cannot type, but react now, please. Because I noticed that when Mr. Timmy sent his material yesterday, at least to about 1 or 2 group chats, nobody even reacted. It was as if you did not need what he sent. So I noticed when I also sent my material also today was still the same thing. I did two SFM groups. I think SFM 3 and SFM 5. I'm pointing you guys out exactly. They are in those group chats. I'm sure you know yourself. SFM 3 and SFM 5. I noticed it today. Same thing happened yesterday. When materials are sent, just click on the material, then do a reaction. It's better. At least it comforts us that like I know I'm sending this to people and they are seeing what I'm sending and they appreciate what I'm sending. At least it gives us morale, it gives us effort, and it keeps us going. Please just try as much as possible to do that for us. That's number one. Number two is you people are not reading. I'm not following you to your house, but what I can tell you categorically is for Apex is different from other centers. Now, why am I saying that? Why am I saying it like that? If you look at our structure, I'm saying this so that for people that are just joining us for the first time, so that you can understand how we work. If you understand our structure, for SFM, we have 3 classes in a week. Although I know your Saturday class we don't hold, I'll come back to that. It did not hold, I'll come back to that. But you've noticed we have 3 classes in a week. For those 3 classes, we are picking different topics. Those topics are topics that they've not got into in your center. Some of them will not get to it. The ones that will get to it in late August or early September. At least like risk management, hedging, investment appraisal, till like late August, September. We've started them here already. Cost of capital. I know some of you that are attending physical centers, you might have started. Some of you they've not started at all till like maybe next month or this month, late this month. But you have started, you have an hedge because you know those topics already. So you have an edge to prepare for the cumbersome one. So what I'm saying is these things are piling up. They are piling up. Mr. Timmy did Sunday. I'm doing today. With the way this timetable is looking like, it's looking like we'll move SFM back to Wednesday. We also have another class on Wednesday. Sunday again, Monday, Wednesday. It's piling up. So are you guys need to do justice to them? It's not only SFM you are writing. I know there are some of you that you are not writing only SFM. So SBR is still there. Some of you will still go and read audit. You still go and do tax. Case study, Mr. KABIRU will still come and teach you guys how to write a whole lot of report. It's piling up. So please, like I always tell my students, they don't used to fail SFM. No, they don't used to fail SFM. You can fail other ones. Don't fail other ones, but don't fail SFM. They don't used to fail SFM. I don't used to teach you that how to fail. If you know that you are not ready to make effort that will make you pass, you can just cut the call and let me leave the class, please. I don't used to teach you that I want to fail. So please, I told you guys from the beginning of this class, I will put all I have. I will try all my possible best. I need you guys to also make effort. Yes, I need you to make effort. The assignment submission for my last assignment, it reduced drastically from the first set that sent. It reduced. I think fewer people sent this time. I don't know why, but fewer people just sent this time. So please try as much as possible to still put effort inside this thing. So I needed to say that. I needed to put that out there before I can start. Thank you very, very much. Let me begin the class, please. Let me start the class. Before I begin, I'd like to ask this. Please, do you have any question? Please, do you have any question from cost of capital? No one ask me a relationship question. My wife has not gotten home. What should I do? Don't ask me that one. Ask me SFM, cost of capital question. If I have cost of capital question, please, can you signify so I call you so that you ask me, please? Any question on cost of capital regarding anything we've done? Anything at all? No question. So you guys saying you understood everything I've spoken about in cost of capital? Is that what you guys are saying? Are you saying you understood everything we've spoken about in cost of capital? Damilo, answer me. Abi Binusa, ask me, please. Abi Binusa. Okay, I don't think you want to. I don't think. Okay. Anyway, so since you guys have said, you under Ngozi, please ask me your question, please.
Good evening, sir.
Good
Actually,
evening,
it's not a question. It's more like a confession. You are right. I am guilty. I have not been reading, and it is piling up.
Oh.
But I will try and make an effort to start, so that I will come back and ask questions. Thank you.
No problem. It's just that you're welcome. It's just that effort that is needed. I know most of you have not started work, ending of the month, beginning of the month, books, and all those things. Believe me, it's not easy. But those are the sacrifices that you make. Just like I saw a tweet recently. Somebody said it's not the ICANN certificate that I got that I'm happy about. Though. You see those lectures, those weekend lectures that will not be going anymore. You pay me past the ICANN lecture because from Friday you're already sad. Mr. Chijoke, please fast. Cost of capital questions. Fast, please. I need to move on. I have a lot to do today. Yeah.
Please, sir, it's not a question. Can you please give us the number to send the assignment again? I sent the assignment
Somebody
to.
help me drop it on the chat box. Somebody should help me drop it on the chat box. I don't know the number of fans. Somebody help me drop it on the chat box, please. Thank you very much. Idem Davin, I think that's the last question I'm taking, please.
Good evening, sir.
Good evening, Ma.
Please, my question is on both equity and debt finance. Actually, I was trying to solve a question from Pathfinder. I think that should be May 2020. I now saw equity and debt is equals to 1. Which, when I was trying to solve the question, I now discovered that equity plus debt was 0.5 in their answer. But in the question, it was 1. So I'm like confused how they get that 0.5 from what they say it was 1. Thank you.
I would answer that question in 2 ways. The first way I'll answer it is the fact I don't know if you know, but the Pathfinder could be wrong. I don't know the question you're talking about, but yes, the Pathfinder could be wrong. And I'm not saying the Pathfinder is wrong. Or it could be wrong. That's number 1. Number 2, I feel like for us, we've not gotten there. Because that is when we talk about debt to equity ratio. So if debt to equity ratio is 1, there can be scenarios. Yes, there can be scenarios where debt can later now be 0.5 and equity is 0.5. There can be scenarios. I'm not saying that's what's happening in that question. I'm honestly not saying that question. I'm not going to lie. But when we get to debt to equity ratio, I feel like you understand. From next week, I think we should get there. You understand majority of these ratios. We've not gotten there with the things we've done. We are starting from the very, very least basics. So that when we talk about debt to equity ratio, debt to equity ratio is 60, debt to equity ratio is 40. What is debt? I feel like you understand better when we get there. I'll find more. Thank you very much. Thank you very, very much. Now, since you guys said you understand, since you will not ask me a question, I will ask you a little question. So please, if you just know the question, just signify. Please, let's do this fast in the next 10-15 minutes. Please, fast. Why am I doing this? Some of you, I feel like this man does not know what he's doing. Maybe this man is wasting time. I'm not wasting time. What I'm doing is, what we need particularly is when we start doing WACC, weighted average cost of capital. And when you start doing weighted average cost of capital, that is where majority of the work is, because you will need your knowledge of cost of equity. You need your knowledge of cost of debt. You need your knowledge of cost of preference shares. So I don't want you guys to do garbage in, garbage out. That if you don't know this one, you're going to struggle when you get there. So you really need to understand this bit, because you will not escape it. When you do investment appraisal, you discount with either WACC or cost of equity. Or because there are some situations where there are some investment appraisal that you discount with cost of equity. When we talk about APV, you discount the APV with cost of equity. When we talk about your free cash flow to firm, you discount your free cash flow to firm with WACC. So there are when we get free cash flow to equity, discount with cost of equity. So you need to know these things very well, so that when you get to those places, you will not struggle. So that's why I'm trying to do a little bit of this and that, so that you understand very well. So if you understand this question, please just raise up your hand. Let's do it fast, sharp, 10-15 minutes. My first question, please, what forms our capital? What are the things that forms our capital? If you know, just raise up your hand. I call 1 or 2 people, will move on. What are the items that form our capital? Fiti Adioti, please, fast.
Debt and equity.
Debt and equity, which is very correct. But debt and equity, preference shares. Preference shares also have debt, have equity. Yes, so debt, equity, preference shares. Thank you very much. That's number 1 question. The second question I want to go to is, if you want to calculate our cost of equity, we have 2 methods of calculating our cost of equity. What are the 2 methods of calculating our cost of equity? If now, please talk to me, please, fast.
APM and the dividend method.
We have the dividend valuation method and we have the CAPM, which is your capital asset pricing model. Now, my next question, let's talk about dividend valuation method. For dividend valuation method, is based on the assumption that dividend is going to be paid to the suppliers of funds. Now, my question is, what's the formula to calculate dividend valuation method? What's the formula to calculate dividend valuation? Omotola Alaba.
It depends. If the dividend has been paid, that would be dividend. Cost of equity will be dividend all over market price. But if it has not been paid, that is cool. It will be cost of equity is equal to dividend all over market price minus dividend.
Okay. What I would say is, you are correct. I will not want to spoil the way you understand it, because I feel like that's the way you understood it. But it's fine. But for me, if somebody asks you, what's formula for cost of equity? It's better to say DO, your dividend over your XDiv. XDiv means excluding dividend. That dividend has been paid, which are correct, very correct. Then if dividend has not been paid, that is cum div. So you subtract your share price from your dividend to get your XDiv. You are very correct. If that's the way you understand it, it's fine. That's what I always say. Picture these things, solve, and the way you know it, carry it like that. Just make sure you understand what we are saying. So she's very correct. Cum div means it's cumulative of dividend. Ex div means it's excluding of dividend. And I've told you that whenever you want to calculate your cost of equity, always use a share price that is excluding dividend. Yes, now, if you want to quote, if you have XYZ company, maybe my company, Olanshile PLC now, I want to tell somebody that my share price is 1 naira 25 kobo. Is the assumption, it makes sense for me to say 1 naira 25 kobo is without dividend. How will I say 1 naira 25 kobo and I've not paid dividend out of it? If I not pay dividend, what happens to the share price? It will reduce now. The person that have not told that last price, do you understand what I'm saying? So whenever you want to quote your share price, always quote it exclude without dividend. So if you want to calculate your cost of equity, is your DO over what? XDiv share price or market value. She's very correct with that also. Please always make sure your market price is excluding dividend. Thank you very much, Ms. Alaba. Now, I also said in class that there are some situations where agreements can change. Whenever agreement can change, is I can tell you that, okay, come, this particular money you are giving me, I will pay you fixed dividend, agreed. But this fixed dividend now, I'll pay you this, I will be paying you dividend, not fixed dividend. So I'll be paying you dividend, not fixed. I'll pay you dividend. But this dividend now, I'll pay you 1,000 naira for 2 years. But in the next 3 years, I'll pay you, this 1,000 will go by 5%. And I told you in class that it is only biochemistry students or agricultural students that can just assume that 5%. Just say 5%, 10%, just say the percentage or the growth rate anyhow. And also as a financial manager or strategic financial manager, you don't just assume that growth rate, that there are 2 ways to calculate that growth rate. What are the 2 ways I said? Unena, please. Unena.
There are 2 ways. We have the historical pattern and the Gordon's growth model.
We have the historical pattern and we have the Gordon's growth model. Thank you very much. For the historical pattern, I said the historical pattern is based on history of the dividend paid. History of the dividend paid over time. And I gave you 2 formulas for the historical pattern. What are the 2 formulas I gave? Yomi Ogungbe.
That is, the first one is N into roots, latest dividend divided by base dividend. Then the second one is N minus into root.
Sorry, can I answer, sir?
Come again, Mr. Yomi. Come again.
Okay, so I said N into root, latest dividend divided by base dividend, or N into root N minus 1.
You're still wrong. Baker Comfort, please talk to me, please.
Okay, so is G equals to bracket, open bracket, LD over AD, close bracket, raised to power 1 over N minus 1.
Lie.
That is for historical.
Lie. No be me teach you that one. It's not me. Martha Alaps, please talk to me, please.
Okay, the first one is N into square root of latest dividends minus base dividends minus 1, or N minus 1.
No be me talk that one. No be me talk that one, say. Latest dividend minus base dividend, okay? No be me teach you that one, no.
Over, rather, is over.
We are starting again, fast.
Okay, N into root L, latest dividends over base dividends minus 1, or N minus 1 into root latest dividend over base dividend minus 1.
Thank you very much. Mr. Yomi, can you see where you got it wrong? There's minus 1 in front. And Miss Comfort, I don't know that formula. Will not be me give that formula that you said. Anyways, that's for that. So I said those are the 2 formulas, which is the first one is N minus 1 root latest dividend over base dividend minus 1. Then the other one is N minus 1 root latest dividend over base dividend minus 1. One has N, one has N minus 1. Now my question, when do I use N minus 1? When do I use N? Fast. Wait, I feel like you are struggling because you're not putting your previous hand down. I'm only calling people that are putting their new hand up. Do you understand the hair? So that is where the challenge is. So
Can I answer?
no, please. Thank you. You do not raise up your hand now. People are just raise up your hand, then I would select. Thank you. Who can I call? Looking for somebody that has not answered my question previously. Can the user?
Yes, sir. We use the first one, that is n square root L dividend over base dividend minus 1 when the latest dividend and current dividend are given. Then we use the n minus 1 square root L dividend, latest dividend over base dividend minus 1 when the years are given year by year.
Okay, you're very correct. You're very correct. So what he's saying is you use the n minus 1 when all the informations of all the dividends over time are given to you. Example, they tell you that the dividend is going to be paid for 5 years, and you give information for 2020, 2021, 2022, 2023, 2020. All the information for all those dividends are given to you. Use n minus 1 with latest dividend over base dividend minus 1. But if it's just information for this year's dividend and the first dividend that was paid that is given to you, just those two alone, you use only n square latest dividend over base dividend minus 1. So that's for historical pattern. Now let me go to Gordon's goat. What's formula for Gordon's goat? Somebody fast. Formula for Gordon's goat. Oh yeah. Idem Davina, please.
G is equals to R times B, where
R times B. Yeah. Fire on.
Is equals to earning all over capital employed or earning all over opening share price fund. Then B is equals to 1 minus DPR or EPS minus DPS all over EPS.
Thank you very much. What she's saying is R times B, where your R is your rate of return, and your rate of return is your earnings over capital employed. Your capital employed, which is a combination of your shares plus your debt. Oh, so the network took me out. Sorry. Please, can you guys hear me now?
Can hear you, sir.
Okay.
Yes,
So I was saying,
hearing you now.
I was talking about the retention rate, which is your B. I said your retention rate is simply your earnings per share minus your dividend per share over earnings per share, or 1 minus dividend payout ratio. Your earnings per share is your earnings over number of shares. Your dividend per share is your dividend over number of shares. So that's where we ended our dividend valuation. Then we'll move to CAPM, where we spoke about the formula for it. Said CAPM is based on the assumption that investors are risk averse. Where we said CAPM formula for CAPM is risk free. So it equals to KE equals to risk free plus beta open bracket RM minus RF. Where your RF is your risk free, your beta is your beta, then your RM is your market return. And I told you that sometimes some questions can give you market premium. So market premium simply means is RM minus RF. So what it means is don't subtract your risk free from your market return. Just use that information of that market premium given to you in that question. So that's where we stopped. So that's where our cost of equity. Then we'll move to cost of debt, where I said we have two types of cost of debt. We have two types of debt. So we have the redeemable debt and the irredeemable debt. Where I said if you want to calculate cost of, so where I said the redeemable debt simply means that at the end of the debt period, the principal will be paid back. That's a redeemable debt. But for irredeemable, the principal will never be paid back. It's just interest that will be paid over time. How do you know when it's redeemable and how do you know when it's irredeemable? Sometimes the question will say redeemable or irredeemable. Sometimes the question will just put number of years. If number of years is involved, it means that that particular debt is redeemable. Yes, now it's redeemable. That's why number of years is there. If number of years is not there, it means that debt is what is irredeemable. If you want to calculate your irredeemable debt, your formula is your interest open bracket 1 minus T over your X interest price, or your market price. The treatment of market price of debt is almost or same treatment as market price of equity. The meaning is when you want anytime you want to quote the value of your debt, always quote it without interest, always quote it ex int. When you are quoting your shares now, you know you are quoting your shares ex div, that is excluding dividend. And when you are quoting your debt, also quote your debt excluding interest. You cannot tell somebody the value of my debt is 100 naira, and inside that 100 naira you have not paid interest. If you're not paid interest, that means the value of the debt that you told that person is not correct now. So it means that always quote your debt excluding interest. So that's what we spoke. And if you want to calculate your cost of irredeemable debt, you use your IRR, your internal rate of return, when you select one discount factor to give you positive NPV, one discount factor to give you a negative NPV, you put it in the IRR formula. That's for debt. Then we'll move to cost of preference shares, where we spoke about it's still the same, it's almost the same thing with debt. We spoke about the redeemable preference shares and the irredeemable preference shares. For redeemable preference shares also means the number of years will be included. So what it means is formula for irredeemable preference shares now is your dividend over what? Over ex-div share price or your market price also. And for irredeemable debt, for irredeemable preference shares is also still your usual IRR. I think that was where we stopped. But there's something I failed to mention last week where I think I should mention. I've seen students make a mistake where they give you question. When they give you a question, they will give you equity in the question, preference shares in the question, then debt in the question. Then they will not write their student. They will not say the dividend is growing by 5%. Listen to me. They will not say the dividend is growing by 5%. Now, mistake that I've seen students make is that when you are calculating your cost of equity, you will grow that dividend, which is very correct. That means you will do your DO, open bracket, 1 plus G, close bracket, over ex-div share price plus G. Very correct. That same student, when you are now calculating cost of, let me say, irredeemable preference shares, cost of irredeemable, you will not take that deal, you will not still grow that deal. You are shooting yourself in the leg. Preference shares, cost of irredeemable preference shares. For preference shares, you are paying a fixed dividend. The dividend cannot grow now. If something is fixed, can it go again? It cannot go now. The dividend that you are paying for preference shares are fixed. Is a fixed amount. So that particular, Mr. Bolanle, please your microphone, please now. So that particular dividend cannot go again since it's a fixed dividend. Don't forget when we're explaining preference shares, we said that preference shareholders are paid a fixed dividend. You make profit, you don't make profit, they get paid. So since you are paying a fixed dividend, that dividend cannot go. If examiner did not exclusively state it there, please, if they stated that preference dividend is growing by, please go and grow it. Listen to what I'm saying. No. Don't say, Mr. Ola said it cannot go. If the examiner say grow it, grow it. But I'm telling you from normal perspective, they are being paid a fixed dividend. So normally, it should not go. But if the examiner say grow it, please go ahead and make the growth. So that's what we spoke about in our cost of equity, cost of debt, and cost of preferential. Now I'm about to move to WACC. I'm about to start the class now. So now, after doing all of those, now I want to move to weighted average cost of capital. What's the meaning of weighted average cost of capital? Why do we even need to go there? Why do I even need to come here? Why can't I just be using the usual ones I've been doing? Now, what I'm telling you is the usual thing that most of you have seen. You have seen companies' capital structure or their equity structure consisting of all these things we've mentioned. What I'm saying is whenever you see maybe Olanshile PLC's capital structure, you see that my capital structure consists of equity, it consists of debt, it also consists of preference shares. Now, what I'm now saying is how do I now calculate the cost of each and every one of these things that I mentioned? If I want to discount anything and the equity has debt, it has preference shares, let's say I'm looking for money. Don't forget the example I gave earlier. I want to invest in real estate. I need 1.5 billion. I have 1 billion. I need 500 million. That 500 million, if I decide to source it in these 3 different ways, that is, I decide to use equity. That is, I want my shareholders to give me money. Do you understand? I want my shareholders, without diluting my fund, though, without diluting my shares, I'm not selling my shares. I just want to collect money from my equity holders. They have their cost of that particular capital they are giving. Let's say I want to collect 200 million for them. They have their cost of that money they are giving me. I also want to as well go to the bank to collect 200 million. They also have that particular, for that cost of debt, they also have a cost included. The last one, let's say I want to also issue out preference shares. I want to use preference shares for the last 100 million. It also has a cost attached to it. Now, what I'm saying is, which of these costs would you now pick? Which of these costs would you now use? Now, if you were a science student, some of you say science student don't suffer from my hand, but just leave them like that. If you were a science student, you could have done Timbo or Tinkolo about that thing that is to Timbo, and guess one of them. Say, let me use my cost of equity, nothing will happen. And you have three. You say, let me use my cost of preference shares, nothing will happen. Say, let me use my cost of debt, nothing will happen. But as a financial or as a strategic financial manager, you cannot do Timbo. Yes, now, because don't forget that you want to maximize shareholders' funds. How are you banking on increasing shareholders' funds when you are guessing? How do you want to use guess funds to increase somebody's money? Do you really want to base guesswork on somebody's lifetime investment? This is somebody's life involved. Some people are doing all their savings for you to invest. So you cannot afford to do Timbo. So now what I'm saying is that is where your weighted average cost of capital now comes in. So you not take a weighted average. You take a weighted average of all of them, of the equity, of the debt, of the preference shares, because they include the three of them. If they don't include the three of them, they just include two, and you take the weighted average of the two. Now, what I'm now saying to you now is that because I've said you will take weighted average of the three of them, does not now mean that they tell you that cost of equity is 10%, cost of debt is 10, cost of preference shares is 10. It does not mean that you take the three of them, add it together, and divide it by 3. No. I'm not saying divided by 3. There is a particular formula that you can use to calculate the weighted average cost of capital for the three of them. Now, that formula is in your material. I'm expecting everybody to have opened their material. So the formula for you to calculate the cost of capital, if you have those three capitals in your structure, in your capital structure, if you have the three of them, there's a formula. The formula is you say your cost, you say your KW. Your KW now is your cost of your WACC, your cost of WACC or WACC. You say WACC equals to your equity. So you say your WACC equals to your cost of equity. Your cost of equity times, you open a big bracket. You say equity over equity plus debt plus preference shares. You close that bracket. It's in your material. Open it. Plus cost of preference shares times, open a big bracket. You say preference shares over equity plus preference shares plus debt. You close that bracket. You say plus. You say plus KD 1 minus T. Cost of debt is always post-tax. You say KD open bracket 1 minus T. You open a huge bracket again. You say debt over equity plus debt plus preference shares. You close that bracket times 100. So what it means is you need to get your cost of equity. You need to get your value of equity. You need to get your value of debt. You need to get your value of preference shares. You need to get your cost of debt. You need to get your cost of preference shares. So if you have all those information, you can substitute them in and get your WACC. That's what you need. Now, if you want to get this particular WACC, now that I've said, don't worry, we'll solve questions after I'm done explaining. If you don't want to get this WACC that I've just said now, there are two methods to get this particular WACC. Yes, you can use two methods to get this WACC. You can use book value, and you can also use market value. You can decide to use book value, and you can use market value. Something inside me really wants me to ask you guys differences between book value and market value, but I don't really have time. So I'm just, so that mosquito will not bite me too much. So let me just simply explain it myself. Now, when we mean book value simply means historical value. It means the value in your statement of financial position. It simply means, it means values that you have created using accounting principles. It means values that whenever you open your statement, whenever you open your books, you are seeing that particular value. That is what is called a book value. But market value simply means the amount or the exact value that that particular item or that particular shares is currently selling now in the market. Keba, are we together? We together.
Yes, sir. We are with him.
Thank you very much. So book value amounts in your statement of financial position. Let me give you an example. Let's say I buy a laptop last year, okay, let me say I buy a laptop last year in 2024. I bought a laptop for 400,000 for 2024 and 2025. I bought a laptop for 400,000 in 2024. I would have done depreciation on that particular laptop to reduce the cost. So now let's say my depreciation at the end of the day was about 50,000. So I would have depreciated that asset for 2020, for the whole of 2020. Let's say the 2024 depreciation was 100,000. So I would have depreciated that asset for 2024 for 100,000. So it means that the carrying amount that will be seen in my book as of 2025 would be what? 300,000. The cost was 400. I've depreciated 300. Now what I will be seeing in my book now will be what? 300,000. That is the book value of that laptop. Does it mean that if I take that exact laptop to the market, does that mean that's the exact value? No, now the market value will be different from that book value. So market value is just the current amount that laptop is selling for in the market. That is just market value. So you can use market value and you can use book value to calculate your work. Whenever you are using book value, just pick information in the statement of financial position. If you are using book value, just pick information from the statement of financial position. But if you want to use market value, just look for the market price. Mr. Matola, I know you know what market. I'm sure you know when I say market price. Market price is in questions. They give you your XDiv. Your XDiv is also your market price. Yes, now they give you XDiv. XDiv is your market price. They give you X interest. X interest is your market price. So just multiply that particular XDiv. Just multiply that particular XDiv by the number of shares. Let's say we have 1,000 shares. You want to get the current value, so just multiply that 1,000 by the value of the XDiv. So that means you are using market value. Now, in examiner will not tell you the one to use. Say use market value, use book value. Some questions they can. Fine, some questions they can. But in some questions where they do not, you are free to use anyone you want to use. Yes. In questions where it's not stated that use this one, use that, you are free to use. I don't think only if the examiner just want to test you that we ask you to use the two. But if you are not asked to use the two, please just use the one you are very, very comfortable with. Some people will even do hash total. We'll leave hash total is a little bit here and there. So let's just stick to book value and market value. So those are just the two methods that we use for our weighted average cost of capital. Yeah, I don't tire. So please, somebody so I'm going to pick about 4, 5, 3. Do you know the deal now? That will read question for me, and I would also call figures for me. Please, can somebody help me check how many questions do I have on? How many questions do I have on? I'll take your questions, please. Just hold on. I'll take your questions. Can somebody help me check how many questions do I have on WACC? Somebody help me check, please. How many questions
3,
is in that
sir.
our WACC question bank? 3 questions, Abi?
Yes, sir.
Okay. Okay. Let's see if I can. Let's see if I can solve. Let's see if I can solve all of them. I hope. So please let me take. So please, based on this my explanation, please do you understand? Do I have any question? Can raise your hand if you have any question for me, please. Do you have any question? Omotola, you want to ask me a question? Omotola Lamba, your hand is up, please. Just
Not
ask me a
yet,
question.
sir.
No,
Not
yeah,
yet.
fast.
Oh, sorry. Not yet. It's a mistake.
Okay. Please, do you have any question? None at all. Please, can I start? Ladies in the house, please. Permission
Yes, sir.
to fire.
Continue, sir. Yes, sir.
Thank you very much.
Permission granted.
Thank you very much. Oh yeah. So let me pick people that read questions from. So like I said, they said we have 3 questions there. So let's see if we can solve the 3 questions. So this is what I intend to do. I intend to solve those 3 questions. But from WACC, we are moving to project specific. But I don't want to go to project specific yet. So if I am chanced on Wednesday, maybe we have our class on Wednesday. So maybe 1 hour or 1 hour 30 minutes. I'll just try to bring 1 or 2 more questions, maybe directly from your ACCA question bank, just for us to solve. Because when we get project specific, it gets quite deeper. So I need to make sure that you've understood WACC first before I move to gearing. Because when we get to project specific, we'll talk about gearing, ungearing, regearing, formula to ungear, formula to regear. When do you need to ungear? When do you need to regear? Debt to equity ratio. Talk about all those things when we get there. So, but for now, I need you guys to understand WACC. Now, like I said, before I continue, I'm going to start solving questions now. But please, let me give you first class. Maybe I will say this at the end of the class. So please, let me pick 4 or 5 people that read questions for me. I think somebody wanted to ask me a question. Said, I think I saw your hand up earlier.
No, sir, it's no question.
Said, I think so.
Sir, it's no question that I want to ask. So.
Okay. Okay.
Sir, we are not seeing your screen. We are not seeing your screen, please.
I'm not showing anything on my screen. That's why you're not seeing my screen.
No, sir, we all have it with us here now. We need not to see your screen, sir. Thank you.
Okay. I was just explaining. Everything is in your material. You don't need to see my screen for anything. All those things I will explain. I will just saying it from my head. Now you will see my screen. Don't worry. I'll allow you to see my screen now. So yeah, let's start. So I was about to pick 4 or 5 people that read the questions for me.
Can I read questions?
Who be that?
Said, sir.
It's only women.
Ladies Sonia are allowed to read here. Are you Bobrisky?
The only software now. Hardware.
He said that you Bobrisky. I beg, you usually me. Mr. Said, I'm very sorry, Jerry. Men voice they give me headache. And if I get headache, I don't go feel so well. So make I just not just get headache.
I understand you fully, sir.
That is the best antidote. The best antidote.
Thank you very much. So I think Miss Faith Adiot, I think you've helped me before.
Yes, sir.
Faith Adiot, I think you yeah, I think I was good with your work. So I think you can continue. So I'm going to pick 1 or 2 people more. Mr. Lapbo is not here. I'm trying to pick people that we've worked together, that we've really done work together before. Olayinka David, I think I know that name. That name sounds familiar. Peggy Oluchi, are you there? Are you calculator?
Olayinka David is a guy.
I know. The name just sounds familiar somehow. I know. I know some people go call figure for me. We are only men foods class. Peggy Oluchi, Ruth Oladele, Omoyeni Joy, Omolola Praise. Please, if you are there, just let me know you are there, please. Omolola, you can unmute your mic, just unmute and let me know you are there.
Okay, I'm here.
Please, are you a calculator, please?
Yes, I'm here.
You a calculator? I know you are there. Do you have calculator?
Yes. Yes, sir.
Thank you. So, please support Miss Faith to call figure for me. If you are there also, please support them to call figures for me. I think I'm okay with that. Too much women service is not good. Now small make I pick small. So Omolola Praise, Ruth Oladele, Faith Adioti, and Ifena. So please, those 4, please call figures for me and read questions for me, please. Thank you very much. So please, let's start with the first question. Anybody? Let me find out. Please, I hope everyone can see my screen. My screen is showing now. So if you cannot see my screen, most likely it's from your end.
Yes, sir.
Please, can you all see my screen, please?
We can see you, sir.
Thank you. Thank you very much.
Yes,
so yeah, please, question. The first question on WACC, please.
Number 1. The account of Olori PLC reveals the following capital structure: 1 naira ordinary share, 2 million naira, reserves 3 million, 10% debenture 1 million, total 6 million. Market value of the above shares is as follows: ordinary share of 3 naira, 3.75 kobo, ex dividend, debenture stock 18 naira. The cost of equity is estimated to be 20%. The cost of debt is 7.5% after tax. Required: what is the weighted average cost of capital using book value and market value?
Thank you very much. So one minute, let me just say something. Last week I gave an assignment on assumptions of CAPM. If you did it and you did it correctly, I know some of you are like, how would you know you did it correctly? If you use Google. I know you don't know it, but Google is correct. So just copy and paste and go and put it in your notes. It used to come out to small 5 marks, small 3 marks, adjustments of CAPM. I gave it in our last class. Please, if you did it and you did it, go and copy and paste it in your note. I'm giving another one now. Assumptions of WACC. I'm sure some of them are even in this material, but I'm not just so sure. Assumptions of WACC. Also carry that one, put it in your note also. Read those things. 5 marks can help you. So please read that one too and also put it in your notes. So assumptions of CAPM and assumptions of WACC. Oh yeah, let me start. So what's today's date? People say I should be writing date.
4th of August. Monday.
4th of August. So let me see. But so we are saying weighted. So let me just write WACC, please, so no get strength. So WACC. WACC means weighted average cost of capital, please. I'm not getting the right the full meaning. People should leave me a beg. So so let's say question 1, Abi. So question 1. So what's the name of the company again?
Olori Ebi PLC.
Olori Ebi PLC. Olori Ebi PLC means head of house. Abi head of home, then anyone that you want to use. So we use book value, then we'll also use what's the name? Then we'll also use what's the name? Also use market value. The good thing about this question is, let me go to the question again, then let me analyze the question together. This is not how all questions will be, because for this particular question, they've given us our cost of equity and they've given us our cost of debt. Other question will ask us to go and calculate cost of equity, but when we get there, we'll see. So now let me write the WACC formula first so that we know what we are looking for. So you say KW. KW means your cost of WACC, or yes, KW. You say equals to. So you're going to say somebody's unmuted, please. You say KE multiplied by, let me do this big formula thing. So you do this. So you say your equity over equity plus debt plus preference shares is in your material. I'm just simply copying it out for you guys again. You now say plus. So I'm going to copy and paste this, so I don't really get strength like that. So you now say plus cost of preference shares times preference shares up here over equity plus debt plus preference shares plus cost of debt, open bracket, 1 minus T times debt. Debt is on top of here, debt over equity plus debt plus preference shares. So in the question, do we have preference shares in the question?
No.
No, so we only have information for debt and equity. Okay, so let's now come here. So let's say let's use book value first. So using book value. Don't forget what I told you. If you are trying to use book value, all the items in your statement of financial position are things that you will take account of. So now let's start with equity. So for equity, so let's add up all our equity together. So let's come here. So equity. So what are the items of equity I have there? Oh yeah.
1 naira ordinary share, 2 million.
So you see ordinary share. I'm doing money here. Don't call number of share. I'm doing money. So let me say ordinary share. Let me do this so that it's clearer. You see ordinary share. So what's the monetary what's the monetary amount?
2 million naira.
Let me ask the classic question. If this ordinary share had been quoted at 0.5 kobo and the number of shares is 2 million, what would have been the value I would have had? Imagine this share was quoted at 0.50 kobo and the number of shares is 2 million shares. What's the value?
1 million.
0.50 kobo times yes.
0.50 kobo times 2 million.
Yes. 4 million.
Okay. So
4 million.
So this one
It's
I'm
4
going to
million.
It's 4 million. Okay.
4 million.
Is it 4 million or 1 million? I mean 1 million. I mean 4 million. Which one is it?
4 million.
1 million. 1 million.
It's 1 million, sir. 1 million.
No, that be 4 million.
It's 1 million now. It's 1 million. Why are people saying 4 million? They say 0.50 kobo and it's 2 million naira shares. It's 1 million now. That's the amount. If they say you go and buy, they say 1 cup of rice is 50 naira, and they say you bought 2 million naira, 20,000 bags. 20,000 bags. How much did you spend? Maybe it's 20 1,000 times 50 naira. But this one is 50 kobo now. So 50 kobo will be 0.50 times 2 million. So it will reduce now. Oh yeah, so ordinary share, please always add your reserves. Reserve is also an equity. So you add your reserve. What's the value of reserve in the question?
3 million.
3 million.
3 million. You say 3 million.
But I thought reserves are not added.
I swear.
You say underline. So you say so you add it together. So what do I have?
5 million.
5 million.
Okay, 5 million. So this is your equity. Let me bold this. So bold it. Then from there, let's do debt. So from here, you say debt. You say debt. So what debt do you have there?
Debenture.
10%.
Debenture. It's just one. How much is it?
1 million.
I think that's 1 million. So we already have everything we need now. Our cost of equity is in the question. We already got value of our equity. We already got value of our debt. So let's put it in this. Let's put in this form in this formula. So let me copy this. So what's our cost of equity in the question?
20 kobo.
Cost of equity.
20%.
20%. What's the value of our equity?
5 million.
75 kobo.
Please let's leave the answering of the figures for
Hey,
people
1
that
naira. Sorry, 1 naira.
Thank you. Please, hold on, please. Let's leave the answering, the calling of the figures to avoid all these plenty figures, please. Let's just leave for people I called, please. Thank you very much. You can participate, but answer it. You just mute your mic, then answer it. Then you will know if you are correct or wrong. But if we are about 100 in this class, now everybody's giving different figures, the class would not be in order. So please, thank you very much. So our value of our equity is what? You said 5 million. So what's our equity? So our equity is 5 million, Abi.
Yes, 5 million.
Okay, 5 million.
Well,
Our debt is what?
1 million.
Million. Since we don't have preferentials, I'm just going to cancel this. So that's that for that. So you come to, we don't have preferentials, so I can easily eliminate this since there's no preferentials in the question. If there was, you will use it, but since there is none, I can easily eliminate that. So what's my cost of debt?
7.5%.
But 7.5, they said it's after tax. So it means that they already done this 1 minus T. So I don't need to do 1 minus T anymore. That's the meaning. If it was before tax, that means they had not charged tax. So you can come and do it. But since there is after tax that's in the question, you can easily eliminate this. So you say 1 million over our equity is 5 million. Our debt is 1 million. We don't have preference shares. What's my work? So what do I have for the first one?
16%.
Is it the total work? I'll be just the first, like I mean.
No, that's for the first one. For the first one.
That's 5,000 over 6,000. 16% plus. Don't give me poison. You.
It's 16.7.
You don't start. 16.7. What do I have for the second one?
.01. 0.01.
That's 1%. Is that what you're saying?
Yes.
So what's my work?
0.7.
Cannot hear you.
17.7.
17.7%. Say approximately. 10%. So this is how you use your book value. Don't, if you notice that all the things I use from this book value are things from where? They are items from that particular statement of financial or that financial position given to us. Those were the things I used. Please, that is how you do that. Now let me use market value, please. You'll now come here. You'll say using market value. And I told you your market value is simply the majority of those XD, XINT, because they are the current market value that that particular debt is going for, or that that particular equity is going for. So that those are the items that you will use. So please always use your XD share price. They are the share price and they are the current share price, the market price. When Mr. Omotola was defining that, said the market price, the XD is also referred to as market price. So they are the current market price. So for your equity now, so for your equity, what is the market price of our equity?
3.75.
So let me say 3.75 naira. What's our number of shares?
2,000.
2,000?
2 million rather. 2 million. That would be 7.5 here.
2 million shares. So what do I have?
7.5.
That's 7.5 million.
Yes.
So for my debt, for market value, you would not, for market value is just that value of equity, nothing concerning reserve with market value. When you're using book value, you add your reserve to your ordinary shares. When you're using market value, it's just that equity you use alone. So for this one, what's my XINT?
18 naira.
That's 0.80. I think the question should be 80 kobo, not 18 naira anyway.
Times 1 million.
Times 1 million shares. So what do I have?
800,000.
100,000. So this is everything we have. So let's go and put this in our. So please give me total. I don't want to be breaking them out like this. So just give me total. What's the total of this?
8.3 million.
8 million.
Sorry, sir.
300,000. Is it a question? Abi, you've given me poison. Which one?
Yeah, no, it's
correct.
It's correct.
Okay, so let me bring this formula down here so that I can use. You see the way I'm writing my formula every time I'm doing new thing. I'm not doing it because I like to type. I'm doing it so that you learn how to present. You see, I'm doing it so that you learn how to present. So let me remove this preference share since I don't have it in the question. Is it gone? I think it is. So 20% times, what does this become? What's my equity? 7.5. Are we?
7.5.
So you say 100,000. Okay, don't go do what I don't know. 100,000 over 8.3. 8.3. What do I have? What do I have for the first one?
18%.
The first one?
18%.
18% for the first one.
What do I have for the second one?
0.7.
Give that child his daddy. Yeah, what do I have total?
18.72%.
18.72%, approximately what? 19. Sure. This is what I have for my work. It's no more than this. So the only difficult part is when they now ask you to calculate cost of equity. And your exam cannot be like this one that we solved. Most exam questions will ask you to go and calculate that cost of equity and cost of debt. So you now use all the information that you've learned. But these are just the basics which I need you to understand. So please, do you have any questions regarding what I did, please? Any question? You can raise up your hand. Let me look at it. Okay. Olademeji, please question me, ask me. Olademeji, ask me. Ask me, oh. Cannot hear you. Okay. I think you're mind. Olademeji, can you hear me? Oh, okay. Kendi Yunusa. Please talk to me, please. Okay, so I'll take it that the questions are not. Please, do you have any other questions? Should I continue, please?
Sorry, sir.
I hear you now.
Sorry. It was when they were doing the book value, where they did the 1 million divided by 6 million times 7.5. I don't know how they got to 1%. It should be 1.25%.
You don't know how they got to what? Talk to me now. I don't know how they got to
1%. That 1 million divided by 1.25.
It wouldn't change anything. You see, be approximately 18%. Because if you do 1.25, it still becomes approximately 18%. Oh, fine. Thank you. It's just approximation. Nothing serious. Thank you. Your me open your question, please.
Okay, so sorry to disturb, sir. So when you were actually explaining the reason for calculating work, I was fighting with network, so I don't actually have the basic understanding of that explanation you were giving. So sorry.
You can just simply I don't know, maybe when you can watch that on YouTube now. But the reason is just because we have the three in our capital structure, nothing too much. It's because the three of them are in our capital structure. But if you want a more detailed explanation of when, please just check, just keep that place on YouTube. Just watch only that place alone. I think you will get it. Thank you. Amara.
Yeah. So my question is, the place you use
What?
zero naira 80 kobo. In the question, what was given is the venture stock of 18 naira. So I was thinking that it should be 18 naira, not like 80 kobo.
What was given what?
How did you get the like when you wrote
Don't talk
0
to me now.
naira?
What was given where?
Can you hear what I'm saying?
Say it very well. I did not hear you.
Okay, I said we use 0 naira 80 kobo. But I thought what we are supposed to use is 18 naira.
I corrected it and said the question should be 80 kobo, not 18 naira.
Okay, sir. Thank you.
Oh. You're welcome. My internet is not stable, so all this I really cannot take much question, and I have a lot to solve. Oladimeji, please talk to me. I called you earlier now. Hello.
Yeah, sorry, it's my network. Now, based on what my sister just said now, I thought
Oladimeji, you are using a plan, but you are not unmuting your mic.
I'm not muting. I've unmuted my mic, sir. Hello, sir, can you hear me, sir? Hello, sir. Hello, sir. Can you hear me?
Is it my network?
Yes, we are hearing you. Go ahead now.
Okay. My question is this: the venture stock. Are we not supposed to divide it by 100? Debt. Are we not
Why?
supposed to divide debt by 100 to get our market value?
Why?
You know, so for valuation, we said, how will I put it? Oh my God. You know, for debt, we always divide them by 100, the nominal 100, so that we get.
I
How will
really
I
cannot hear
explain?
you very well. I don't know why you are. I don't know why that is. I don't know if it's my network, but can you guys hear me very well?
Yes, sir. Yes, sir. We are hearing you.
We can hear you loud and clear.
We are hearing you.
Is it me? Can you guys hear me clearly, please?
I can
Sir, we
hear
can
you
hear you
too.
loud
The
and
network
clear.
is bad for me.
Yes, sir. I can hear you clearly.
You guys should mute and let me know if you can hear me now.
Sir, we can hear you clearly.
We can hear you, sir.
We
Can
can
you
hear
hear us?
you.
We are hearing
We
you.
can hear you very well.
Audible, we
Oh,
can
God
hear
have
you
mercy.
clear.
Please, can anyone hear me?
Is your network, sir? We can hear
Sir,
you. I
it's your
don't hear you
network. We can
clearly.
hear you
Now
loud
we
and
can
clear.
hear you.
That's not hearing us. I
We
think
can
it's
hear you.
network. We are hearing you. We can hear you, sir.
Is it better now?
Yes, sir, we can hear you.
Yes, sir.
We
We
can
can
hear
hear
you,
you,
sir.
sir.
Yes, sir.
Okay. Thank
Yes, sir, we can hear you.
Thank you very
So
much.
go ahead.
So please let me just continue solving. I don't think I will take any more questions. Please, my network is pretty bad. So please, but I think I understand what Mr. Alanimiji, if you can, I think I understand what you are saying. What you are saying is that the debenture should be divided by 80, should be divided by 100 because of the face, because value of a bond is the value of a debt is 100 naira. I understand what you are trying to say, which makes perfect sense. But what I'm saying is you know this because either you've written SFM before because you know that the value, but for me as a lecturer, I'm starting from the basics from students. I cannot just start here and start saying value of debt is 100 now. But from the next question, I can comfortably mention that even in the question, listen to what I'm saying. No, in the question says 80 naira. It's just me that is changing it now to 80 kobo because I don't want to explain the value of a debt like that. What I'm saying is previous diet where we would have done bond valuation, students would have understood the perspective of face value of a bond being 100 naira. But now that they've removed bond valuation from the syllabus, you cannot just come here and start mentioning value of a bond is 100 naira in the first question. That's why I just said change that question to 80 kobo. That's why I just said it. But in subsequent question, I think we'll go there. Anyway, so please, number 2 question, please. Thank you very much. Number two, please, somebody.
The management of Aremu PLC has tried to decide on the cost of capital to apply for the evaluation of investment projects, each currently quoted at 1.7 naira per share cum div. It has also issued 200,000 naira of 10% debenture and have a current market value of 105.3 and 100,000 naira of 6% preference shares currently quoted at 40 kobo per share. The preference dividends has just been paid. The ordinary dividend and debenture interest are due to be paid in the near future. The ordinary share dividend will be 60,000 naira this year. And the directors publicize their views that earnings and dividends will increase by 5% a year to indefinite future. The fixed asset and working capital of the company are financed by the following. All figures are assumed correct. The company tax rate is 40%. Required, advise at the Group PLC on the appropriate cost of capital to use for its investments.
Thank you very much. Thank you very, very much. So for this particular question, let's do a little breakdown on it. So if you look at the question very well, so did not give us, so we are supposed to calculate our cost of equity, we're supposed to calculate our, I think they have preference shares and we have debt also in the question. So we're supposed to calculate cost of equity, cost of debt, cost of preference shares as well. So we're going to break them one by one. So we're going to have a cost of equity. So we want to calculate our cost of equity now. So let's start. So you say, this one should be in your workings. So let me just say, I'm just going to start here, say workings. So you say workings. So you now say workings one. You say calculation of your KE. Now let me ask the class. Using our KE now, we can use two methods now. We can use dividend valuation or CAPM. Based on the information given to us, which one are we supposed to use?
Dividend valuation model.
So you say calculation of KE using dividend valuation. We are using dividend valuation because information given to us are basically dividend. There's nothing on risk-free, nothing like beta, nothing like market return. That one is settled. I will know that if we want to do our dividend valuation method, formula for our dividend valuation is KE equals to
dividend.
You say DO. Is that good?
Yes, 1 plus G.
1 plus G.
Over market value X div.
It's not the same. You can market value or X div, don't join them together. But let me use market price over market price, so that's our market price plus goods. Now this is our market price now. Is it now we have what's the value of our dividend in the question?
60,000 naira.
So dividend equals 60K. But this dividend now we cannot use this. This is a full dividend, so we cannot use this full dividend. So we convert it to dividend per share. So we say dividend equals. So let me say. So you say 60,000. What are our number of shares?
150,000. I'm sorry, 500,000. Sorry.
What do I have?
60 divided by 500.
I'm converting this thing to per share because our market price is per share now. So you cannot put the whole value of dividend on top of per share. So you convert dividend to per share. It says 0.12.
0.12.
0.12. So that's our dividend. Fine. Let's also our market price. Our market price is it cum div? Has dividend been paid or dividend has not been paid?
It's cum div. Dividend has not been paid.
Dividend has not been paid. So if we want to convert it to X div now, so we say our market price. So let me open brackets here. Say X div. That is dividend has not been paid. You will now say is equals to your what? Share price minus your dividend. What are share price in the question?
1.17.
That's 1.05.
1.17 minus what are dividend? 0.12.
0.12.
What do I have?
That's
1.05.
So that means my XDV is share price. And my what's my growth in the question?
5%.
Yeah, that means I'm good now. So let me that means I have all the things I need. So let me go and put them here. So we said our dividend here is 0.12. 1 plus 0.05 Which one is 1.0
1.05.
plus
0.
0.0? So what's my KE? You see what I was telling you? Knowledge of cost of equity. You will need it. If you did not know these things now, you would have struggled here. So you needed this knowledge.
0.17.
0.17.
That's 17%.
That's 17%. Damn, you know, pass like this. You know, pass like this. Although this should have come here anyways. This one would have fallen under. This one would have been under workings. This one would have been under workings anyways. So that's for that. Now let's go and do cost of debt. Cost of debt. Now my next question is the cost of debt. Is it a redeemable debt or irredeemable?
Redeemable.
So let me do cost of preference shares first. So let me do cost of preference shares. Is the preference shares redeemable or irredeemable? Is it a redeemable preference shares or irredeemable preference shares?
Redeemable in 2 years.
Redeemable for 2 years.
Preference shares, no more so.
Yes, redeemable.
I'm going to look at the question by myself because I don't.
Wait,
I don't
almost stated.
So it's redeemable. They said to be paid in the nearest future.
Okay.
When is nearest future, ma?
Yeah, it has just been paid. Oh, sorry, it does.
Madam, when is nearest future? And even here, I said the preference dividend has just been paid, and the ordinary dividend and debenture interest are due. That's just dividend, though. They said dividend are to be paid in the near future. Don't forget what a redeemable preference share means. It means that the principal is the principal that will be redeemed in the number of years. So they said dividend will be paid in the near future. It's not even concerned either is this particular preference share that me I can see here. It's an irredeemable preference shares now. See the way, okay, look at it from this perspective. Look at the way debt is. It says it also shows 200,000 of 10%, which are redeemable at par in 2 years' time. That's clear. But for preference shares, there's nothing like number of years. Now, this is what I was telling you. It would not give you number of years. Read question SFM. Let me tell you something. You are in for a lot. SFM is not hard, but it's just paying attention to details. Listen to me. Pay attention to examiners. It's English. For some of you that did not do GES in school, that you used to skip GES, maybe you should call your lecturer. If in school, if you can give you maybe 1 month sharp class. You need to pay attention to English. Here, it says that preference dividend has just been paid. The preference dividend has just been paid. It does not concern you. Dividend does not determine if it is redeemable or irredeemable now. Is it dividend that determines? No, now, the only thing that dividend determines is, has it been paid? If it has been paid, ex-div. If it has not been paid, cum-div. That's the only thing that dividend determines. The thing that determines if it's redeemable or irredeemable is the principal. It's the principal that will determine, okay, is this particular one redeemable or irredeemable? And in this question, there was no information or whatsoever about principal when it comes to preference shares. So for me, it is irredeemable preference shares. Please, are we together?
Yes, sir.
Thank you very much.
Yes, sir.
So you now come here, say cost of preference shares. What's formula
Yes,
for calculating?
sir.
What's formula for calculating cost of preference shares? So you say fixed dividend. Fixed dividend over what? Fixed dividend over what?
Market value of preference share.
Say market price, market
Of
value.
preference share.
ACTI.
Or ACTI. Yeah, it can be this. So according to the question, what's my dividend? What's the fixed dividend?
What? 6%.
So that's 0.06, I mean. What's our XG? What's our market price?
40 kobo.
That's 0.40. What do I have? But we're looking for 6%. 6% is the interest now. That's the 6%. That's the percentage. This 6%. And some people are looking for it. This is 6%. Whatever is in front like this is the interest. If you come to the statement of financial position, you see it here again. 6% preference share. So it means 6% is the interest. You are charging 6% of this amount. That's the dividend that you are paying on it. So that's 0.06 over 40. What do I have?
That's 0.5.
0.5. That's 5%.
That's 15%.
So you say your KP equals to 15%. Note something, student. Let me ask, or let me change the question a little. Imagine that this scenario, listen to me. Imagine that this scenario had said preference dividend has not been paid and ordinary dividend and debenture interest. Okay, imagine because I said preference dividend has not been paid. What would you have meant? What would I have done?
Yeah, we deduct it from the market
price.
Because it is cool.
You deduct the dividend from the market price. It no
Yes.
pass like that.
Yes.
It's not more than that. It's just English. What they are telling you here that preference dividend has just been paid. So know that XD, ordinary dividend and debenture interest are due to be paid in the nearest future. They are not telling you to know that okay, the ordinary shares in the ordinary dividend in your cost of equity is cum div. And I'm still letting you know that even interest in your cost of debt is also cum int. Because interest here too are due to be paid. That means interest has not been paid. So when you get cost of debt, know that it's cum int that is given to you, not X int. It's just all these simple details. They pass like this. Let's do cost of debt. So the debt now, is it redeemable debt or irredeemable?
Redeemable.
Redeemable. Since it's redeemable, what does that mean? How do I calculate it?
Years.
IRR.
So
We use IRR.
So you come to working.
IRR.
Yeah, I'm going to do it. No. So you say working to do. You say calculation of cost of irredeemable. Sorry, redeemable now. Cost of redeemable debt using IRR. Now let me ask you guys a question. Now that they've said that, listen, this is how we know if you guys have been understanding me. Now that they said that interest, they said that for cost of debt, interest is coming, Tabi. That means interest has not been paid. What
Yes,
do
sir.
I do?
You look for our interest.
I'll look for interest, but we don't start to.
You
said
minus the
interest-
interest from the market, from the market value, current market value.
From the current market value, thank you. What is the interest?
It will be 10% times 100.
What is just the interest? What is just the interest alone? The coupon, bond valuation. I don't know why they remove bond valuation.
That's 10%.
10%.
But the interest is 10%. That's the coupon.
Yes.
That's 10%. How do I now convert? How do I now get? How do I say that? Don't give you a expo. Don't forget what you said. You said I will subtract the interest from the current market value. What is the current market value?
105.3.
So subtracting my interest, what do I have now?
95.3.
Do you understand?
Yes.
So what it means is when you are doing your IRR for your current market value, you cannot use 105.3. You have to use 95.3 because that 105.3 is cum int. I don't know if you understand what I'm saying. No?
Yes, sir.
So let's assume 5% first. But don't worry, when I get there, I'll explain better. Assume 5%. So let me go and copy and paste one of these IRR that we've done earlier. What did we do in this class? And you did not correct me. I'm sure some of you have done copy and paste. And my God has caught you people. Why are we assuming 10% here? We are assuming 5%, and my discount factor is still 10% here. What would I have done? I don't know the one that is correct, though. I'm just going to choose 5. I don't know the one that is correct. But I will know now, sir. In that class, people that were in that class that called figure for me. Well done. Well done. No. So 5%. So I'm going to say discount factor is 5%. Now, what I'm saying earlier is the current value of this particular debt should have been 105. But that 105 is cumulative of interest. What I'm telling you, you cannot say the value. See, the current value of every debt is always 100 naira. Listen, no. Current value of every debt, or let me say, no, not current value now. The nominal value, or the book value, or the fair value of it, or of every debt is always 100 naira. The way the nominal value of shares is 1 naira, is the same way the nominal value of a debt is 100 naira. The way nominal value of the shares is 1 naira. The same way nominal value of every debt is 100 naira. Now, what I'm now saying is, this part for this, the nominal value of this debt should have been 100 naira. But the current market value, that is the amount that they are selling that particular debt. Some debts are tradable now. You can buy some debts. Yes, now bond, debenture, those ones are tradable. So what I'm saying is the current value of this particular debt now is 105.3. Listen, that's the current market value. But that 105.3 now has interest inside. That interest cannot, the person will pay the interest now, whether you like it or not. So what I'm saying is that 105.3, you should not do your cost of debt with that 105.3 because it is cumulative of interest. So what it means is subtract your interest from that 105.3 so that you have your current market value. So, like you guys said, you said we have 95.3 now, Abi. Please, that was as a result of them saying interest has not been paid or is due to be paid in future. Due to be paid in future means it has not been paid now. Hey, that's why due to be paid in future means it has not been paid. If that particular interest had been paid, it would have been a different ball game. It would have just been it would have still been our 105.3 that we would have still used. Oh, yeah. So
but
yeah,
I'm not supposed to tax from
we are getting it. We cannot deduct. Okay, thank you for that question. But the thing is, the tax is not. Let me explain this thing like this. Listen to me, please listen attentively to me. Do you know that this current market value is not a money that is entering the lender's hand? Let me give you guys a scenario. Let me give you guys a scenario. Miss Fetia, I come to borrow money from you. I say, okay, please borrow me 1 million naira. You say, okay, no wala. You give me 1 million naira. Now, what I'm telling you now is that you not say that, okay, I'll be paying you 10%. You know, it's going to be that 10% on that 1 million naira that I'll be paying you as interest. Now, what I'm telling you now is that the tax that will be paid will not be on the redemption value, it will be on the interest. In your statement of profit or loss, is it not interest that you used to deduct? Is it interest that you used to deduct tax from? It's not from the principal amount. Is it from the loan amount inside your statement of financial position that you used to deduct tax from? If it's from the interest, that is statement of profit or loss. So it's on interest that used to charge it's from interest that used to charge tax. What me I'm now saying now is that 1 million naira, that is the debt that you borrowed me. If we want to value that present debt in the market, maybe in respect of a bond or anything, it might not necessarily be 1 million naira. It might be 1.5. That 1.5 is the current market value of that debt. But that 1.5 million is the current market value of that debt. Interest, let me now ask a question. The interest that I'm paying you, is it going to be on that 1.5?
No.
I'm asking the question.
No.
I don't know if you guys understand what I'm saying. Let me come again. Let me do the scenario again. I'm borrowing 1 million naira from her. Listen, no. I'm borrowing 1 million naira from her. I'm paying 10% on it. 1 million naira. Or don't let me use 1 million naira now. Don't let me use naira amount. Let me use bond. Let me use bond so that I can use the 100 naira as a face value to see what I'm saying. Let me use bond. And let's say she sells bonds. Then she says she come and buy, but then I want to buy. Let's say I decide to buy 100 bonds from her. Listen, I decide to buy 100 bonds from her. For that 100 bonds, the face value of one of those bonds is 100 naira. Face value of the nominal value, the way nominal value of every share is 1 naira now. Nominal value of a bond is also 100 naira. So you now multiply that 100 bonds I bought from her times 100. Abi, that would have given me the total amount that I would pay. So I'm assuming that should be like 1 million naira. Now, on top of that 1 million naira, she now asked me to be paying 10% on that 1 million naira, which is fine. What me I'm now telling you categorically in these classes, you cannot charge tax on that 1 million naira now. You will charge tax on the 10% interest that I'm paying now. You will charge tax on the 10%. When you do your statement of profit, it is sales. How do you do that in? Cost of goods sold. How do you do that in? Profit. You will not do interest. You will not do profit after here. You will not do profit after. You not do profit before tax. You will now charge tax, but you would have charged your interest. It's always profit before interest and tax first. You will now charge your interest. That's, it will not give you your profit before tax. You will now charge tax. Then you now have profit after tax. That's why we are doing 1 minus T. That's why we are doing 1 minus T. So it's like it's interest that you charge your tax on. Now, my own question of what I'm not telling you now is that 10% that I'm paying now, the value of that, when we did that transaction, value of that bond, it was 1 million naira. It does not mean that if you go to the current bond market today, the market value of that bond would not have increased or have reduced. Can go either ways. It could have increased, it could have reduced. What me I'm now saying is that 10% that I'm going to be paying Ms. Fetia, is it not going to be on the nominal value that we agreed, or it's going to be on the market value?
On the market value.
It's on the nominal value. It's on the nominal value.
It can never be on the market value. Now, it was not on the market value that we are now. Never. We didn't agree on the market value. What the bond is in the market is not my business. I just want to know it, to know the value of the bond presently. It's just for information's sake. For me to just, or for her to just know that, okay, oh, maybe this bond is going up or it's coming down. If you buy shares, people allow me to do too much of examples. If you buy shares, let's say you buy shares for, you buy any amount of share, they are paying you an amount of dividend, an amount of dividend. If that price of that shares, the market price of that share should go up, it does not affect the dividend that you are going to be paid now. What I'm saying is, if you are being paid a fixed dividend, I hope I'm not using a wrong example with this equity self, but I hope I'm not using a wrong example. But what I'm just saying is, market value sometimes is just for information's sake. That does not really depend on the interest that you are going to be paying. If the value of the bond is now 1.5 million or 2 million naira, does that mean I will not be paying 10% of 2 million? Was that our agreement at initial stage? Our initial stage was 10% of 1 million. Whatever the current market value of the bond is not my business. I just want to use it for information's sake. That is why this current value is at year 0. That is the value of that bond as at today. Subsequently, is not. I'm not aware. So that is just what we are trying to do. So, Ms. Adiote or Ms. Fetia, sorry, the interest, the tax is going to be on the interest, not on the current value, please.
Okay, sir.
So, the years, how many years is that question?
2 years.
2 years. So you say year 1 to 2. So fixed interest of how much?
Should be 6.
That's after tax.
10%.
What's the initial rate?
10%.
10%. Good. Now let me now tell you guys something. For people that like to read books, people know that I will tell you. For people that like to read books, you can see some book, they will use 10% here. You also see some books, they will use 6%. Now, this is the trick. It's not a trick, but this is the analogy. If you come back to this, your WACC formula, you see that WACC formula has KD1 minus T. So what it means is, if you are charging tax on this your WACC formula here, don't charge it here. If you are charging it here, don't charge it here. I don't know if I'm making sense. Only charge your tax once. Shebi is the cost of debt that you are going to get here. After you do 5%, you do 10%, you put it in WACC formula, you get IRR, you get one figure now, maybe 6%. If you have charge tax here and you still bring that same 6% and charge tax here, does that not mean double counting? You are charging your tax twice now. So you can only charge tax once. So either you decide to charge it from here. Now I told you from the beginning that people that were feeling hot, they will start to feel cold. Now people that were cold, even me that I was cold before, I don't the hot. I don't come out that big hair. You don't the rich work. What I'm saying is charge your tax only once. Don't charge it twice. If you now let me tell you the best scenario. The best scenario ever, the one that I like to use, and I always advise my students to use is for this particular part, for this table, leave tax. Do you understand? For this IRR table, don't charge tax. So that you can, because this one already has, this one is a formula that you have crammed in your head. This one is already in your head, KD1 minus T, KD1 minus T. So believe me, if you have charged tax here, you will definitely be tempted to also charge tax, or sometimes you will forget. Because this is the formula you will write. So what I always advise my students, when you get here, forget there's anything like tax. Don't charge tax on this 10. Use your 10 like that. Then when you get to that up, go and charge tax. So what I'm saying is if you see some textbook, they will charge the tax here, but they will not charge it here. They will not charge it in their WACC. And you see some, they would have charged it down there. Yeah. And you see some, they would have charged it down there, but they will not charge it here. So I'm just saying so that you know situations of majority of this particular thing. So that's just basically the story behind it. So for here now, for the purpose of this class, I will not charge tax on this particular one. So please, what's my annuity, please?
10. Okay, 1.8594.
1.86. You approximate.
1.8 what?
859.
Give me 3 decimal, 859, Abi.
59, yes.
Okay. So what do I have as my PV?
My
It's
that's 18.59.
18.59. So what would be my redemption?
0.907.
No, I mean what would be this particular redemption?
It's 5.3. No, it's 5.2.
Redemption value, what would be here is what I'm asking.
It's 5.3.
How do you get 55.3?
100.
That's 5.3 minus
100 now. It's 100.
Redemption is 100 now.
You said redeem at par.
They said it is redeemed at par. At par means it's redeemed at that particular phase, at that particular nominal value. Nominal value of a bond is 100 now. So they said it was redeemed at par. So it means it's redeemed at 100 naira, at that particular nominal value. So it would have been at 100. They don't do 95 minus 3 minus 10. What would be that? So what do I have here?
From 0.907.
0.907. So what do I have? That's 90.7 here.
90.7.
What do I have here?
13.99.
Positive or negative?
Positive.
So since this is 13.99, and I want to, what do I want to do? I want to reduce. Don't forget what I said. The higher your discount factor, the lower your NPV. The higher your discount factor, the lower your NPV. And I need to reduce this thing to negative. So I will increase my discount factor. So let me come here. So let me just say 10. Let me say assume 10%. You say assume 10%. So you say current value still the same, fixed interest 10. So what would have been? So what would be my discount factor here?
1.736.
736. So this is 73.6 here.
Yeah.
So this is still,
no, this will be 17.36.
Sorry. Too much there. This is, what's this?
0.826.
0.826. So that's 82.6, yeah?
It is so big.
What do I have?
To still give us positive.
To stay positive, 4.66.
You still give us positive?
Yes, 4.66.
Yes.
Times I should have done that.
15%.
I should have
15%.
I should have used a larger number. Yeah.
Use 15.
Stop,
How do I have an
please, can we use like
15%?
12%?
Zero 1.626. 626.
I cannot hear.
That'll be 16. 1.626.
1.626.
626.
What do I have here?
16.6.
Give you 16.26. What do I have here?
0.756.
0.756. So this is 75.60. What do I have here?
That's minus 3.44.
What do I have? Oh,
minus 3.44.
Distract you, sir. Fixed interest. I don't know about you.
minus 3.44. Like this?
Yes.
What's wrong with all of you now? Don't you know it's late?
What? Oh, fixed interest.
What's happening now? Who is disturbing the class? Oh, please, let's be guided. Okay, so let's continue. So I'm going to get my IRR formula from somewhere. So I hope you guys know IRR formula, or I will not be writing it for you guys. You guys are in professional level now. Do you know that? Make I no talk. Variable will chop my head. When I was writing exam, if lecturer should tell me that thing, it always make me sad. So which one be I'm in professional level? Are you not happy I'm in professional? Let me continue. So this is 13.99 close to 13.99 plus 3.44. 10 minus 15 minus 5.
Yeah.
Will this give me the answer I want? Oh, yeah.
Should I give you a straight answer? 13%.
Yes, please.
13%.
15.
13. 1 and 3.
Is it 15?
13.
Please do this thing very well, please.
13%.
Let me do something. Sorry. Let me change something. To avoid, how would I say it? To avoid a big gap. Let me explain. IRR is expected to give you different figures, yeah? Listen, IRR is expected to give you different figures. Everybody is expected to have different figures. But for me, I always like to minimize my risk. Me positive. Why not let me use 10 and 15? Do you get what I'm saying? I feel like 15 and 10 is a whole lot of gap. It's a whole lot for me, but since 10% is giving me positive, why can't I just use my positive like that? So please let me change this 5% to 10, please. Sorry, my bad. It's just for me to reduce my errors. Just for me to reduce. Everybody that does
So
IRR
if
will
it goes
get
up
most
to
likely different
4.66,
answers. So your cost of debt will most likely be different because most likely everybody will assume two different rates. Do you understand? But me, I don't just like it to be more than 5. I yes 6. But this is 10. This is too much. So please, so give me my figures for 10, please. Very sorry. My bad.
Hello, sir. I want to
So what's that
Hello,
discount factor at the area?
hello, sir.
Sorry. Fast, please.
Hello, sir.
sorry,
Can you hear me,
sir.
sir?
1.62 something.
What of
61.
tax on the interest?
Yeah.
Tax on the interest. Can I see phone?
1.736. 736, sir. $1.736.
This network this night get us a bill.
Hello,
Oh
sir.
yeah,
Tax
let's be
on
fast with
interest.
it. Oh yeah. What's my
736. 1.736.
1 point what?
736.
Oh, sorry.
Hello,
1.6
can you hear me?
what?
1.736. Can you hear me? Hello? Can anybody hear me?
Yes, I can hear you. I think his
you.
network is.
For the tax, he said you should leave tax for now. That when you get to
We are
the
going to charge
formula,
the tax on one's calculator or WACC so that we won't make it twice.
exactly.
Yeah, I've been locked out.
Please, or anyone in the house, are you hearing me?
We can hear you. We are
We
here.
can hear you.
Yes,
Before the
sir.
lecturer, before the lecturer is back, how did we get that dividend in that question 1? That 12 kobo.
That's the 6,000 naira for the dividend divided by 500,000 shares.
6,000?
60,000 naira, the ordinary dividend, divided by 500,000 shares.
60,000.
60,000 naira. In the question before the table, they said the ordinary share dividend will be 60,000 naira.
Oh, sorry, I've seen it. Hey, I beg you.
Good evening. Why is the fixed interest not tax? I thought we used to like write 10
Yes,
into 1 minus
it's not
tax.
tax. We'll tax it when we want to do our work. The formula already has KD 1 minus tax.
Oh, okay.
Yes.
Are you sure the lecturer did not set its time to 11 o'clock and he forgot? And probably the network, the settings logged him out. So I guess
If the
this one
setting
is
logged him out, it will be everybody. The setting log everybody else. I think it is one personal network.
Please, how do we get 95.3 as our cash inflow for the current value?
Our coupon rate is 10. So
Okay.
100, and they said our market value, we still have our interest inside. So we have to make it X interest. So that 105.3 minus 10 will give us 95.3.
Okay, thank you.
That's your congratulations. Just wait for your icon price.
Amen. In Jesus' name, amen.
This one that you're doing is it seems like you want to win icon price. We were just here to pass. So I beg.
But I can't price. That one is too far. Let me just have my mark and be going my 50 and be going on my merry way. I beg.
That's the way you.
After you have accepted the price, you are now belittling yourself. Abba.
Have you heard me ask her to me to pay?
Aim big. You're going far. I can see it from here.
Should in case you win the prize, just transfer to those that need it. Who collect.
If those who are collecting it can, you can also. You can.
That's
No, me, I
that's all
can.
I can.
Well, like what I just want is just 50. I don't know how to even point on that 50 I big.
Don't just aim for 50 so that
Has,
you won't go
has
below.
someone been able to reach out to him? Probably private chatting.
Someone should reach out to him. Do you know if he's coming back?
Please, with this IRR, my cost of debt is 13.02. I don't know if I'm correct. Has anybody tried to finish up the
Yes, it's
calculation of
correct.
cost of debt?
13%.
Okay.
Can you guys hear me?
Yes, sir.
Yes.
Yes, we can hear you.
Welcome, sir.
We are waiting for you.
Sorry, I already even sent a message that maybe we would meet next class, but as this network was not allowing me, but I had to be patient. Let me just finish this question so that I wanted to solve the last question before, but this network, I doubt it would allow me. So this is what I would do. I would solve this question, then I'll allow you to go and attempt the last one. So that last one is going to be like an assignment for us. So please submit that one. Then from there. So let me solve this one real quick, please. Let me just finish it. I hope you guys can see my screen fast. So I'm saying, okay, let's do 10% of this. So please call annuity of this 10% for me, please.
1.736.
1.736. What do I have here?
17. 626. 556. How many times?
What do I have?
No, sorry.
Yeah.
Sorry, that is 0.826. Sorry.
It's fit, yeah.
Sorry, sir.
You want to give me poison? Yeah. People don't
4.66.
4.66.
4 point what?
66.
Please don't get what I'm doing wrong. If you had 10 and 5, if you use 5 and 15, it would still work. But what I'm doing is me personally, for efficiency's sake and for accuracy's sake, I don't like to use big or too far apart discount factors. So at least 5, I have 6 in between them. So 5 and 10, 5 and 15 look too much for me. That's why I changed it to 5 and 15. So that at least 5 and 10. Since 10 is also giving me positive. Yeah, so it just made sense. So this would have been 4 points. This would have been 4.6. This one now, it will reduce that thing that we got.
That is still 13%.
Still 13%.
12.8 was
We'll reduce this just by little discount factor, anyways. 4.6, 4.6, 3.44. Okay, I think I know where the thing is from. Okay, but now 4.6. 1 minute to fix this thing.
No, it's not so fast.
4.66. What do I have? It's still 9%, Abby?
13.
18.
13%.
13%. Okay. So that's what I was saying. It would have still worked.
Change that first one to 5%.
You have not changed the 5%, sir. The lower rate.
Lower rate.
No, it would not give you something 5. It will not give you something different.
That's 10 minus 15. It's 5%.
It's still 13, Abby?
Yes, sir. 12.8.
No, it's just the approximation on top that will be changing. That's what I'm saying. It's just the approximation on top. Why I said so. That's why I said most people get different answers. Because some people would not approximate. Some people will live like that, but would still be around this particular range. But if you had charged tax on this 10% or on this 10%, it would have given you a different cost of debt, is what I'm saying. So if you see some textbooks, they would have charged tax. I think they would have like 6% or something. So this would have been different. So anyways, that's for our own. So let's go and calculate our what's the name now. So we have our cost of equity now. No, what? This should go up there. So this should come up here. So we have our cost of equity now, we have our cost of preference shares now, and we have our cost of debt. So I think we can go ahead to calculate our WACC. think I'm going to calculate our work. So you say somebody's unmuted, please. So you say work. So let me bring preference shares in now, since I have preference shares now in the question. I don't know why they are making noise in my street by this time. That's why I feel like everybody should be writing like, and everybody will comport themselves. This is 11:17. I don't know why people are shouting in the street. So what's my cost of equity?
17%.
17%. What's my okay now? Oh, this is another issue. So now let me go back to my working. So let me I'm going to use market value. I'm going to use book value to get what's the name now? To get the total. Now let me check something. Can I use book value? Yes, now I can. This is a statement of financial position right here. So I can use book value, and I can also use what? And I can also use market value. So I'll use the two. So now let me say, so you come here. 1 minute. So before you come here, so let me move this a little down. So you say using book value. So you say equity. So what's my equity? So we have ordinary shares, Abi now. So what's the value of the ordinary share?
500,000.
Naira, Abi?
Yes, sir.
You see 500,000 naira?
No.
Okay, to me about one. Reserve.
Should be 880.
Reserve. What's my reserve?
380,000.
So what do I have a total? 880, Abi?
Yes, sir.
880.
880, okay.
880.
So you say preference shares.
200,000. Sorry, 100,000.
Yeah. No more. So what's my debt?
200,000.
Yes.
200,000. So okay, let me move this here so that I can do total of all, so that it's more comfortable for me. Again. No problem for you. So what's the total of all like this together?
1,180,000 naira.
1,180,000. So let's go and put these informations now in our work formula. So our equity here now. So we said our cost of equity is 17%, Abi. So Abi, yes or yes?
Yes, sir.
So what's our value of equity? 500,000. Sorry. 880 over 1,180,000. That's me adding them together. What's my cost of preference shares?
15%.
15%. What's my preference shares? What's my preference shares figure? 100K over 1,180,000. So this one I'm now saying. So your cost of debt here, I can now charge tax. Do you understand? You can now charge tax here. So what do you have? You have 13%, Abi?
Yes.
1 minus. What's the tax rate?
40%.
0.40. So let me reduce this font. So 1 minus 0. So what's our debt? Our debt was 200,000, Abi?
No, 100,000.
Debt. My preference shares was 100,000. Madam.
Oh, sorry, too.
One more. What do I have? This divided by this. It divided by 118. What do I have?
That's 0.75.
0.75.
What do I have for this other one? 100 divided by this.
0.115. 0.08, sorry. 0.08.
No.
Yes, no.
What's 0.40
Okay, yes.
times? What's 60% times 13%? What's 1 minus 0.40?
0.078.
0.078% times. So what do I have? 200 divided by 180.
No, percentage is not there anymore.
0.17.
So that percentage, I've removed it.
7.5.
What do I have? What do I have?
So is it for everything or you want to?
Yes, please, everything.
17%. Okay. 15%. Sorry, is it 15.3%? 15.3%.
What do you have?
15%.
You 15, I'll be 21 by
15.27.
15.276%.
0.3%.
50.3%.
So 15% like this, have you? Now let's use our market value. So this is using book value. Let me mark this. So say using, you can, like I said in class, only if the examiner wants you to use the two, you can use anyone that's comfortable for you. While I was writing my own exam, I liked that when I was praying, I like to use book value because book value is very easy. I know they multiply anything, just go and carry the figures there. But unfortunately for me, I know see book value the other day. Thank God say I know market value, I for cry. So you say equity. So what's my number? What's my XD? What's my XD now?
1.05.
So 1.05 for both. What's the number of shares?
500,000 shares.
500,000 shares. So what do I have?
525,000.
Okay. My preference shares. What's the number?
0.40.
0.40. 0.40 times what?
100,000.
Times 100,000 shares.
Yes.
How
That's
do I have?
40,000.
40,000.
That's 40,000. For my debt, uncle.
95.3.
Now that's what Mr. Olawale was trying to say that time. But I feel like that time I don't mention the book value of a debt. Now, when a debt is given to you, when a value of a debt is given to you like this, and you want to, don't forget what I said. I said that the value Now, what you are trying to get now is, how would I explain this thing now? Hold on. No. Let me say you are trying to get the value per share. Like you're trying to get the value per share. Now, the 95.3 that you were given in the question, that is the, if you read the question very well, is the current market value of 100,000. Now, what I'm saying now is that 95.3, it is, now, this is what I'm saying. This is what I'm saying. If you want to use market value to get, listen to me. If you want to use market value to get cost of equity, always divide whatever value of debt given to you by 100. Because 100 is the nominal value. Now, you're just basically dividing it by the nominal value of the debt. So please always divide it by the nominal value of the debt first before you multiply. For this one, for this equity, was as a result of the nominal value of shares being 1 naira now, so it does not need you to divide it. But for this particular one, the nominal value is 100 naira. If there was bond valuation, you would have seen, but subsequently we'll still do it, where we always divide the value of that debt by 100 naira first before multiplying. So what I'm saying is, so you'd have done 95.3 divided by 100. What do I have? Yeah. This one is getting serious. What do I have?
0.953.
Because I'm a nice person, let me help you write it inside. Let me help you put it inside this thing so that people don't forget. That's what you should have done for that first one also. That first one that we did, but I did not want to mention value of debt as 100 naira then because there was no IRR involved in that one. That's why there was no particular. That's why I did not want to mention the value of debt as 100 naira debt. But now I feel like since we've done it here as redemption value, it makes sense for me to mention it here now. So this like this. Is it better in front? Is it better in front like this? I should put it in the back.
At the back.
This one looks confusing.
No, sir.
It's better at the back.
Even though which one is better. Oh, okay.
Better now.
Yeah. What's the number of shares?
200,000.
Not 400,000 shares, though. Not the shares, though. Sorry. 400,000. We don't look.
200,000.
600,000. The venture. What do I have?
190,600.
One what?
190. 190,600.
What is total?
421,200.
421,200. Cannot be 4 now. See 525 here now.
It's 755.
755,600.
755,600.
Maybe you should leave calculator and go and sleep. This is why you want to feed me what I don't know this night.
That's why she need man for supporter.
It can be 421, already 525.
But allow man. No vex. Now me fuck up.
Yes, so man can do better.
Now me fuck up. So let's go and put these figures in our work. So it's still 17%, but this just changes. So this becomes 55,000, have you?
Yes,
And
sir.
this becomes 755,600.
600.
This becomes 40K. Preferences. This becomes 755,600. Then this still remains the same. This becomes 190,600. Then this what do I have? What is this divided by this?
0.69.
0.69.
Yes, sir.
What do I have here?
0.05.
Thank you, Miss Fitia. You don't wake up. What's this? What's this one?
0.25.
25, are we?
Yes, 25.
What do I have? It should not be far off 15%.
Sir.
Hmm?
So I'm coming. I'm calculating.
Okay.
Yes, 15%, 14.7.
0.144. That's 14%.
0.144.
It's 14%, not.
No, we're going to leave it at 15% anyways. So please, this is that. Please, do you have any questions regarding anything I've solved? Please, that is fast point. Please, do you have any question? Please ask me. Ask me any question. Please, do we understand, please?
Yes, sir.
Okay, thank you very, very much. So this is what we'll do. Please, as I am like this, I have a lot to do over the night. So I'm going to be very much awake to a very good number of hours. So why I'm saying this is number 3 question. I've forgotten the name. Make I check the name here. 1 minute, please. Tojubole PLC. Please, I want you guys to attempt that question. Now, for people that are going to attempt, I need you guys to, I need everybody to submit as early as possible before Wednesday. Please submit before Wednesday. Now, I'm going to give people that are going to do it this night liberty of asking me, how would I say it? If you get lost, you can chat me up. Asa, what do you think? Just, I can give you expo, not expo. It's not as if I'll solve it for you, but if you have any challenge, maybe you don't understand the particular line of that question. For people that are solving it this night, I'm giving you that power to ask me. Ask me on that number, or that my number that you submit assignment to. I will be there. So just ask me. I'll give you that liberty. That's if you are doing it this night. But if you are not doing it this night, after tonight, my liberty don't go and do it by yourself. For people that don't understand anything, that you want my help, and you and if you have asked for my help, make sure you are submitted this night. Don't know why I go give you a finish. You go sleep. Oh. If you ask for my help, do it and submit tonight. I just need you guys to attempt it as they fresh, as they hot like this. Attempt so that when we come with bigger questions, we understand what we are trying to do better. Now, let me give you guys first class news. Now, there is most likely going to be changes in the timetable. Most likely. So either Saturday or Sunday will leave your timetable, then it will come to Wednesday. Before, SFM used to be Mondays, Wednesdays, and Saturdays. That's the way it used to be previous diet. But this diet, we are trying to make a little changes, but that changes now. I don't think it's going to work anymore. So it's most likely going to be Monday, Wednesday, and Saturday. So most likely I'll be the ones taking your Wednesday for now. Mr. Idris might not be particularly available at the moment. So majority of the topics, I will take them with you. So I will be the one most likely taking you on Wednesday. I'm not so sure yet, but it looks like that is what it is. I mean, I don't have time on weekend. My weekend is my own weekdays. So I don't have time on weekend. So most likely going to be Wednesdays. It has not been finalized, but that is most likely what it is going to be. So I will most likely might see on Wednesday. So that's why I want you guys to submit before Wednesday, because most likely I want to see what you've done so that I can grade what you've done. Then what if you do it very well? But if a lot of people attempt it, it will determine if I will solve it in class or not. If a lot of people don't attempt it, I will assume you guys understand and I'll move to the next thing. But if quite a lot of numbers attempt it, I'll try and solve it in class, or I'll just explain. If I cannot solve it, I'll also try to explain it in class. So on that note, I don't think I have anything else to say apart from, okay, so please, for me personally, please, I'm interested. Let me just say this here. I'm involved. I'm about what I said. I'm into what's the name? Deployment of accounting softwares. So if your organizations need any, I'm doing publicity. They used to say is where you eat, is where you work that you eat. Make I no con carry people load for head. Make I drag my own for my hand. So make I carry my own load also for my head. So please, if your companies or you yourself, you are interested in deployment of accounting software, please, you can reach out to me so that we'll help you do the deployment. At least you can do that for me. This man, thank you very much for doing what you do for me. Come and collect 1 million contracts in my office. That I go give you personal class. Me and you alone. If you give me 1 million naira contract in your office, I go do personal class for you and you will pass. Yes, now. You no worry. So please, I'm into deployment of accounting softwares, any type of accounting software. So please, if you need it in your organizations, please try as much as possible to reach out to me. Let me be the first person that comes to your mind. Thank you very much. All those things being said, thank you guys very, very much for listening to me. The network tried to deal with us, but I'm sure we still achieved our goals. So on that note, good night, everyone. Enjoy the rest of your night, and I'll see you when I see you. Good night, everyone.
Nice, sir.
Good night, sir.
Hello, sir. Hello, sir.
Good night, sir. Thank you.
Please, the number. I don't have the number.
It's in the chat box. It's in the chat box. It's in the chat box.
Okay, thank you.
Thank you, sir.
You're welcome. Have you seen it, Mr. Okachi?
No, sir. No, sir.
Please, are you going to drop the one we did tonight?
Yes, I should.
Okay, thank you, sir.
So for people streaming on YouTube that want the number that have not gotten, the phone number is 070.
Yes, sir, you can just call the number for us, please.
69 94. For the number that is in the chat box like this,
Can you take it again, please?
Hello. I can't even hear. I can barely hear you.
Just check the chat box now. The number is there.
I don't know. I can't see the chat box. So I don't know.
For people streaming on YouTube that you cannot see the number, the phone number is 070 85 69 94 47. 070 85 69 94 47. Thank you guys very much. Good night.
Good night, sir.
Good night, sir.
070 85 69 94 47.